In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Good morning, good evening, and good afternoon, everybody. Merrill Chandler here, your host of the Get Fundable podcast. Now, in this episode, we're going to kind of go back. We're in the Wayback Machine, right? Way back. We're going to be talking about the origins of money and how money, paper money, and credit has kind of taken over the original intent for which money was designed, right? It's actually really fascinating. So if you guys would love, I'm a history major, and this was like the most fascinating thing that I learned in the ancient world. And as we went through literally the Roman times, into the medieval times, the Renaissance, and into modern banking. So stay tuned. I'll be right back. And as soon as we get back here, we're going to do a deep dive into literally the Lenders Playbook. This is where it all started. I'll see you in just a second. All right, welcome back, everybody. Merrill Chandler, your host of the Get Fundable podcast. This episode is so much fun for me, and I've got so much to talk about that I'm thrilled that we finally get to go here, right? We finally get to start addressing some of the roots of our modern banking world, right? So this is kind of a two-part series. There's the insider secrets to the Lenders Playbook, Banker's Playbook, and then we're going to be talking about in another episode insider secrets to the credit bureaus and how they have dominated the marketing and the list generation and all the data that is used for people to kind of, if we don't know what we're doing, to take advantage of our ignorance, or how we know how to play their game because we know what their next move is. So, all right, let's get started on the money game, right? Insider secrets to the money game. What is the banker's playbook? All right, so first of all, there's a couple principles I want to set up here. I'll tell a story about this, and I've shared the story once before, but I've done so many episodes that it bears repeating. So back when I was, a tween, right? I wasn't a child, I wasn't a teenager, but back in the day when I was probably 11 or 12, we'd go to certain family reunions, and they loved playing Monopoly. And my uncle who was only a few years older than me, my mom is the second of 14 kids. So I actually had age-peered uncles. Anyway, we went to, we loved playing Monopoly. And he said, hey, you know what, guys? I'm going to tell you what, we're going to do a little bit different take on the game. We're going to charge interest. So you can borrow money from the bank, right? You don't have to just get money by by collecting rents or otherwise. You can borrow money from the bank, and I'll be the banker. So, because I know how this process works. And I'm like, okay. So he says this is what real life is all about, right? So funny. So he plays the banker. And then in some conversation, I was years later, he always won the game. And I always asked him, when we were at the funeral of one of our the older kin folk, and I asked him what was it why does he always want to play banker, and why did he always win the game? And he said, Merrill, there's two kinds of people in the world. There are those who earn interest, and there are those who pay interest. And if you pay interest, you will always end up giving everything of value in your life, financial value in your life, to those who earn interest, those who charge interest. Now, I didn't know I was going to end up being in the fundability optimization and designing all this awesome tech and creating this back there when I was a teenager. But what I found was that there were the truth of this, the truth of what he taught me was so profound. I to this day it still reverberates. There, you can either earn interest or pay interest or both. And for those who only pay interest and without earning it, you're going to end up giving all your money away to the others. And that's why I always won the Monopoly game. So I'll give you the formal dictum here. I have it written down. Over time, borrowers of money at interest will eventually lose everything they own of material value to those of lenders of money at interest. So lenders will accumulate, and we will turn it all over to them. So how does this work? Well, back in the day, let's start in the Wayback Machine. So in the early civilizations, everything was by trade, by barter, right? You'd have 5 cows equal, or 5 chickens equaled 1 cow. Certain rare stones were used in some indigenous communities. Red stones. Unfortunately, the tusks of boars and rhinos and elephants were all worth something above and beyond. And so the more scarce it was, the more valuable, right? Nothing has changed from today. The more scarce it is, the more valuable it is. The thing is, as predicted by lots of great smart minds over the last few decades, knowledge, right? Knowledge is now becoming the most powerful and most rare asset. Having the right knowledge, like what we call insider secrets, having the right knowledge is a game changer for everything that you're doing in your life. So in the history of money, first of all, we start out with the shell games, right? And precious natural or things that naturally occurred in the earth. Well, that turned into special precious metals, right? Gold and silver and even bronze. The original coins were made out of these smelted metals. And the more and more people started doing collecting these special metals, the more wealth they had. Now, interestingly enough, over this time, these standards of money, the standards of trade, have always been highly influential in every community. And where the problems were between the Babylonians and the Assyrians, or between the Egyptians and the Hebrews or the Assyrians, right? All the ancient world, is that the standard became precious metals. So the Egyptians might think a particular lapis lazuli stone was more precious than everything, but lapis lazuli was only valuable inside of Egypt. It didn't translate, so they had to have these means of communication, means of transfer of wealth between these different civilizations. Well, fascinating is that at some point, when as merchants began moving between the different civilizations. Remember, Egypt owned the entire Middle East and enslaved everybody. Babylonians owned the entire Middle East and enslaved everybody else. The Assyrians enslaved everybody and owned all the natural resources. And then it came the Greeks, and then the Romans, and then the Europeans. And this is only in the Western hemisphere, right? So in Western and Northern hemisphere, everybody has been over the long haul of our civilization. Everybody has been a ruler, and everybody has been a slave to somebody. And it is just the barbaric nature of when we conquer something, we enslave the people. All right. But during these periods, every single civilization scattered their influence, and and regardless of what was viable, what was meaningful, what was valuable inside of each of the separate cultures, gold and silver and bronze became the means of deploying wealth and investing wealth and transferring wealth. Now, over time, ultimately, every one of these civilizations had monarchies or kings and queens, and they would, so that they could standardize what wealth looked like in each civilization, they would imprint either a god or goddess. They would imprint the king's face. Some say Darius of Persia was infamous for having his face on coins in antiquity. Everybody would create their coin of the realm, and so that's where that term comes from. Is what is the coin of the realm? And every realm had its own version. Now, when these great civilizations butted up against each other, then and only then did they have to start weighing out what was gold, the purity of gold. They had acids that they would do. Way back in the day, they had acids that would determine, the assayers would determine, just like they did in the gold rush of 1849, they would determine the purity of a metal and then weigh it, and then that is what would happen. And these were all on the borderlands between all these civilizations, right? So then these wealth and conquest was based on taking over another king's or realm's treasury. Now, kings would collect from their people. Now, this is a simple explanation, right? We're not going into every civilization and the various nuances that they did, but as long as kings and queens existed, they had treasuries, and those treasuries and the natural resources that they had, the rivers, the woodlands, the ore deposits, those were what triggered wealth building activities we called conquest. All right, we wanted to, every single civilization was about conquering the next civilization to take over what they had already curated, all of the gold and silver and the goblets and the diamonds and the precious stones. They wanted to, every kingdom would curate out of their natural resources these things for the treasury and possession and ownership of the monarchs. That was the easy. If you could win a war, you gained their treasury. All right. Now, all this is going to come into bear, believe me, in modern banking. But what you wanted, well, think of it this way. Today we call it a book, right? Well, all of these assets, all of this gold, silver, all of the precious stones, all of the human resources, the natural resources would be that would be the equivalent of having a book. And you want to merge or acquire, hostile takeover of another civilization. So every time these happened, there would be a homogenation. It would be homogenized. There would be more. Everybody would adopt best practices of all the other kingdoms. If you go through your history book, the Egyptians adopted the Hebrews adopted the Babylonians adopted the Assyrians, the Greeks. Oh, and the greatest copycats of all time were the Romans copycatting Greek culture, right? It was just prolific. So what does this have to do? Why is this meaningful? Because when you look at your dollar bill or your debit card, you need to understand what money is. And there have been a lot of people say a lot of things about money, but I want to tell you my favorite definition. And again, I'm a history major, so I have read a lot, studied a lot about what were the best practices of the ancient world and even the recent modern world. And what's fascinating is money is stored work. Bottom line, because the only thing a human being actually has is time and abilities to use that time. And the more abilities you have, we call them talents, skills, etc. The more talents and skills you have, the more you can leverage your time. In the modern world, the more knowledge you have. Now, I'm not talking just book smart knowledge. I'm talking about inside secrets to be able to leverage your time. So the blue collar, white collar, all of those collars represent, where's the knowledge collar? Is that the black collar? What I don't know of a term for it, but knowledge isn't just power anymore. Applied knowledge is a superpower. But money is this stored asset. It's stored work. Back in the day, all we had was the ability to break our backs doing a job. And then we learned more. Merchant class began to arise later on. And we were able to leverage our time and our resources, or the available resources. So think of this stored work, because every time you use your debit card or your credit card, this is what you're doing. And we'll cover that in a second. So now, then there came a time from moving from the antiquities, right? We moved from Egypt, the last great southern Mediterranean empire, into the northern Mediterranean empire of Greece. Greece literally just took over the universe of the Mediterranean world, right? Western culture. And then Rome, it lasted 1,000 years, and then Rome took its place and literally copycatted the same deities, the same things that they worshipped, and changed their names, right? Instead of Aphrodite, it was Venus, instead of, and so each one of them, instead of Zeus, it was Jupiter. So every single one of these great cultures had means of storing their work, their and the work of their people. Now, all of this was based on conquest, an aggressive acquisition of another's wealth, right? Human resource and natural resources. Now, while the king may have had gold and silver mines, which he was, which added to the treasury, that took a lot of work to do so. The quickest way to do that, as we've said, is to conquer somebody else. Now, the other thing that was really popular, especially as we moved through the Greek and Roman empires, was that, well, through colonization, right? The Romans went all the way from England, all the way to the Germanic tribes, all the way to Persia. And this colonization expanded the reach of all of these different, all of whoever was in charge of this thing. But when the colonization meant you literally went to, because the further out from the Mediterranean you went, the less and less structured, right? It was more tribal. Same thing happened in the Eastern Hemisphere. The further you went away from the more developed civilizations of China and or Japan, the further out you went, the more tribal it became and the less developed. So the cultures, east, west, followed the same routes. Everybody went further and further and further out into the world to find more and more resources. So that's what happened. That's why we have the stories of Columbus, we have Cortez, all those guys, is they representing at the time, post-medieval Europe, they were going out to the new world, trying to find faster ways to get more from the East Indies, etc. Now, where this comes into play is that one of the greatest things dots that I'd connected ever was where did the Renaissance come from? Right smack dab out of the Dark Ages, the Middle Ages. And you'll be able to do the math that when we go to when Spain and Italy and are all going to the Americas, and they're literally rape, pillaging, and plundering an entire another civilization, in the Mayan and the remains of the Incan and the Aztec empires. They're bringing home all of this wealth through conquest. Once again, through conquest. Once we bring all that here, you have gobs, tons, mad quantities of assets and gold, which they can now mint and put in as the coin of the realm. And you have all this money available. The merchants, everybody that, the tide raises all ships, right? All this money coming in the name of the kings and queens of Europe. The entire continent, European continent, was lifted to a higher standard of living. More and more people began to do more and more trading, and this is what was fascinating. The different people who are following different money lines have subtly different dates. But if you watch my podcast, if you read my book, I say all the time, we've been playing by the lenders have been playing by the same rules for over 500 years, right? Well, technically it's 10,000 years if you want to go how money's been treated forever. But where modern banking started was back in Germany, where there had a number of the goldsmith class began shaping all of these, all of this money coming, just flooding in from all over the world, and the goldsmiths were crafting it into coin of the realm, right? Now, there were a couple of kingdoms that and monarchies that had their own in-house, but many times they used the goldsmiths and the silversmiths to transfer the raw ore or the gold bars or otherwise into usable coin. Now, the goldsmiths ultimately became the first modern bankers. Now, these and this was exacerbated by the fact that a merchant class had come up, and they needed to be able to go from country to country. Now we're talking, let's just focus on Northern Europe. All of us don't have roots in Northern Europe, but it's what I studied, and everything that I'm saying here does have an analog in the South American, like the Aztec Empire did the same thing in conquest. The Indonesians, from island to island, growing and expanding their culture. China, Japan, all had similar analogs to using conquest to acquire this, and how they transferred that wealth and moved that wealth around their respective continents. So I'm just going to focus on Europe for a moment. And so what would happen is it became very costly and very dangerous to pack up, if you were going to go do trade somewhere else in a different region, to pack up all of your gold, put it on your horse, and try and make it from Versailles, France to Paris, or from England to take a boat to go to Amsterdam. Those were dangerous journeys. And so one of the things so there began to be a guild of goldsmiths, and they became a banking guild. And there are a number of different versions of this. I'm just going to use an example of the goldsmiths, because what happened was they began to set standards, weights, and measures that would cross lines. And when I learned this, it was just fascinating, because what I discovered was, for the first time in the Renaissance world, for the first time, really, the independence of money became independent of any monarchy. Up until then, everybody had their own deal going, right? Everybody had their coin of the realm. Every one of them had some the wealth was established as part of a realm. From the Renaissance on, and later, money and banking began to transcend state lines, began to transcend countries, and it became independent. So much so that you may be aware of the Knights Templar were one of these banking facilities. They were designed. They had their original mission was to take over to work to the Crusades, and they set up outposts all the way throughout Europe so that people would have refuge and be able to feel safe in their pilgrimage. Well, they also began to collect and store money so that someone could write and we'll get further into this, but where they could take a piece of paper that said, this Knights Templar branch would give you money so you can go take out gold out of the next Templar branch. So you don't have to take the gold on the road. The Knights Templar wasn't the only one, but those of us who may know it's called Friday the 13th, we think it's a bad day because King Philip of France literally owed in that day tens of millions of dollars to the Knights Templar, and wasn't paying his debts back. And so, as we all do, he set up a justification for him to be able to conquer the Knights Templar, and they purged the Knights Templar and took over all of their banks and assets in France over the course on Friday the 13th. So that's where that bad luck day comes from. But the more important point is that the Knights Templar were one of these outfits that had branches that you could put your money in one, take a piece of paper, and then take money out of a different branch of the Knights Templar. The goldsmiths, the banking guild had these exact things. Once they set up what the weights and measures were, once they standardized, and remember, this is being standardized outside of any of the monarchies, completely outside of the monarchies. Monarchies were borrowing from the banking guilds. Okay, so once the weights and measures were established, they began to introduce what we now call hypothecation. And hypothecation is very interesting. So I'm going to give you Google it. There's great information on Wikipedia, but this is hypothecation in principle. An ancient bank, the goldsmiths, the Knights Templar, whatever, they discovered that, let's say there's $10 million in gold being stored in their vaults. But at any one time, there was no more than 10% of that being written in these paper. They've been called chips. They were more like claim checks, right? It's called script. And if you go to the blog, you're going to be able to see some of the graphics that we'll put in there for you to be able to see, because I actually have some copies of what old script looked like. But these were more like claim checks, right? You put in your coat, but imagine just traveling 100 miles to another city and then showing your claim check and pulling your coat out, except instead of coats, we're talking gold and or silver. So they would store this money in the vault. Never more than 10% was out in circulation, right? First time the word was used back then. So they found that the early bankers found that they could actually give out loans for more money than they had in the bank, because never more than 10% of the actual depositors come and pick up their gold. So that means that they could give paper script, paper redemption coupons, paper claim checks out as loans, and then collect interest on those loans And all of it was backed by this by the gold that was in the vault. Now, this was very localized. When we say, hey, we need to go back into, and in 1913 we left the gold standard. Well, the gold standard started here in localized village and town vaults by members of the banking guild. Now, what we need to understand is that lenders do today what they did then, right? The Federal Reserve is the chief vault, and you borrow money from there, and you only have to have a percentage of the deposits to cover the loans that you have, right? Hypothecation. In fact, we won't get into the details, but look up Basel 3, BASAL 3. Basel 3, just Google it, and it's an international, it's all the international banks are setting a standard for how much you need to keep so that we don't have the banking debacle of 2008. But those are only recommendations. The Basel Accords are not like are not enforced by anyone. They're accords about how to keep the world banking systems solvent. So paper money was being lent out representing gold that was sitting in a vault, but everybody, all the depositors keep their vaults there, whether you put in 2 shillings worth or 20 pounds of gold, it didn't matter. You usually had paper out on that gold, and the gold stayed in the vault. Okay, just like right now, the modern day analog, you may have money in a checking account, but you don't take that cash around generally. You take the debit card, because we've moved to plastic, or you used to take checks. For us old schoolers out there, we'd take the checks and we would go and move those checks around, and it would go back to the bank vault, our checking account, and redeem those checks. So the system has only been more and more refined, and now with all the information that we have, we can shore up against more and more against fraud, against the theft, etc. Now they're mostly now most banking is X's and O's, zeros and ones, right? It's all code. And so there's so many more other things that we can go into here, but I want to move more and more into what the secret of modern lending practices, because fractional reserve, this hypothecation of money is simply lending 5 or 6 or 7 or 9 times. If you have $10 million in gold, you can lend 50 to 100 million in gold-backed paper and make money coming back into that vault, because most people aren't going to actually move the gold out of there. So everybody can say that it is gold-backed. The problem is it's maybe only 10 or max 20% of all the paper out there representing this same gold bullion. It's only backing 10 to 20% of it. Right? So that's also known as fractional reserve lending, right? So remember, people who earn interest and people who pay interest become the haves and the have-nots over time. So let's look at an example of this. So and this is another, it's just funny as hell. It's just funny as hell, right? So let's say you put $1 million on gold on deposit, and the bank is giving you 2% on paid to you as a depositor. So you're going to make 20 grand on that $1 million that year, right? Well, the paper money, so we take that same $1 million, and there's a graphic of this in the blog, guys. You take that same money, that $1 million, and you lend paper money of 10 million, and let's say you charge 10%. We're not even going to talk about the 15 and 20 and 22 of credit cards. Let's just say we charge 7% loans times 10. That means that the interest paid by borrowers is 700 grand for all that money that was lent. So gross profit for a bank is on that same 10,000, that same $1 million gold bullion is 700 grand minus the interest paid to the depositors of 20,000. That's $680,000 net to the bank. Now, we're not talking operating costs or anything. We're just talking cost of money. So that the hypothecation process literally pulls money out, creates money out of thin air, because that money was lent. That $10 million doesn't exist anywhere except on the paper that's backed by the 1 million. It's now that's the rules of the game, guys. When I talk in my boot camp and my book about learning the rules of the game, that's the first one you want to know. So let's look at some modern day applications of exactly how this works. Let's talk about kind of what happens to a mortgage, because all of this is based on hypothecation, right? 10% reserves, 10 times that being lent out, backed by these same reserves, because most of us aren't going to go collect all of our money in cash from our bank. So let's look at a mortgage. In a mortgage, did you realize that there is, in fact, let me find exactly where this is on a mortgage payment. So there approximately, and this depends on amortization schedules and on interest rate, but did you know that on a 30-year fixed mortgage, you are paying, because mortgages are amortized, that means that out of $1,000 payment, the first payment you're paying mostly interest, and so let's say 80% interest and 20% principal. On the last payment, you're paying 80% principal and 10% and 20% interest. So there's a crossover. One goes higher, the other one goes lower. How am I doing that? One goes higher and the other one goes lower. All right. That simple interest is, let's charge 7% over per year. It's 4-year loan. So let's charge all that interest, and then we'll just make even payments. So the same amount of the payment is interest and the same amount of the payment is principal. That isn't how mortgages work. Now, again, it's the name of the game. Through the first year, an average of your $1,000 payment, 80% of your payment goes to interest. Through year 3, 79% of every payment goes to pay interest. And through year 5, an average of 78%. All right. So it goes down after that. But in the first 5 years, you're paying somewhere above 70% of every payment you make goes to interest. And here's what's interesting. Most of us don't keep a loan for 30 years. And so after 5 years, the finance rates, guys, the refinance rates on mortgages, 3 to 5 years, it's like 80% of mortgages are refinanced over the 3 to 5 year period. That means 70 plus 80% of every payment, every time you refinance, interest. The only reason why this process works is because because there's commonly and regularly in appreciation in the value of the home. So our win is that when we refi, we get to either have a lower payment over time, or we get to take money out, and that just keeps feeding the game. But it's the same thing, guys. Financial profiteering is built into every single mortgage because they're not simple interest. They are high yield interest. So when somebody says, "Oh yeah, I got a 7% interest loan," I'm like, actually, you didn't. You got a 78% interest loan. Through 5 years, you're paying 78% interest on average. So there's much better ways to do this. Well, yeah, I'm gonna refer you to my friends. George Antone has a great program on becoming the family bank, etc. Private and making sure that you're paying yourself all of this interest rather than somebody else. There's some great things out there. That his thing is finance.com, FYNANC.com, and there's some wonderful strategies to help you save money and still be in the funding game. All right, now let's talk about credit card debt. We're basically not just credit card debt. This is another way that that without us knowing, we and through our ignorance, most people don't tell us what these are. But let's say that you have a $5,000 credit card that you've maxed out, and I'm going to play minimum 18% per year. All right. If you pay the minimum monthly payment of 4%, it takes you 12 and a half years to pay off that $5,000. But you're going to pay a total of $8,000. 3 of that is interest. $8,000. Now, there are some, if you're in, and I just played small. If you have a $12,000 or a $20,000 and you're making minimum payments, guys, there are 27-year repayment processes that we've run into with our students and clients. It's insane. So that's why we teach in our Fundability, in the boot camp and in my book, even the other podcasts, we teach you keep a minimum of the minimum traffic on the personal side so that you can leverage the goose that lays the golden egg, and then work out any of the balance carrying things on the business side. Now, I also want to share with you one kind of last section of how hypothecation works. Remember, we talked about that the biggest vault of all is the reserve, the Federal Reserve. And a bank, let's say a bank borrows, and we're just going to play the consumer level. A bank borrows $500 from the Federal Reserve. Well, that borrower, that lender can now, because it's backed by the 10%, that lender can now lend you a credit line of $5,000. Just poof, magic, created out of just on their computer systems. They say this $500 is earmarked for that $5,000 credit card. Well, here's what's interesting. Have you ever wondered if you ever got a collection or otherwise? This is a game changer. So just, a spoiler alert, this is a game changer. Have you ever wondered when lenders, why they offer 50 cents on the dollar, 20 cents on the dollar even for a $5,000 credit card? They're saying, you know what, we're going to hook you up. We'll give you 50 cents on the dollar as an offer. So you pay me $2,500 and I'll write off the other $2,500. Now remember, how much money do they have up against this $5,000 credit card? $500. It is real cash that's secure, that is backstopping that $5,000 credit card. So when they offer you what you think is a smoking deal of 50% off, there's still 500% return on their money, plus whatever you paid over 2, 3, 5 years of making payments, all that interest at 18 to 22%. So this is why when I say the principles of fundability, I'm talking about nurturing the goose that lays the golden egg, taking specific care about how to create a personal profile and the corresponding borrower behaviors that are going to make you look smoking to a lender. Part of that is knowing how much money is on the line, how much to not get in debt on the personal side. Now, we can run into problems, and absolutely we got to fix the car on a credit card if that's the only thing we've got. Of course, I get it. But I'm trying to sensitize you. You're counting on me to speak the truth and just to hammer home how this funding game is played. We need to understand that if you get a $5,000 credit limit, they got $500 on the line, period. If you get a $25,000 credit limit, $25,000 credit limit, they may have 2,500, maybe 5,000 on the line. So any settlements above that is profit to them because you've also paid interest before you defaulted, went late, or delinquent, or otherwise. So guys, this is one of my favorite subjects. It's just the reasons behind what we do. So whether we're back in Egypt, minting coins with Osiris's image on it, or we're using a debit card to make purchases and transactions, the principle, the banker's playbook is to leverage their money for profit. The banker's playbook in every way is that they're going to have a little bit and then they're going to lend a lot of it. And we need to understand that that's their motivation. Now, I don't make them pariah. I don't hate them for it. This isn't about a revolution. It's saying, what are the rules of the game? Let me play by this game. Let me start using my credit to leverage at multiple times. And that's why I end on this, as I do over and over again. Remember how we talk about getting a business line of credit and how it's different than a loan, like a business loan? A business loan, you go through the application process, you get approved, you use the money, and then you pay it back. A credit line is exactly what lenders are doing. We have put our financial reputation on to backstop that. Let's call it a $50,000 credit line. We have our financial reputation, our borrower behaviors. We have created a confidence in a lender to give us this $50,000. But what are we leveraging? That we get to do a deal, pay it off. Do a deal, pay it off. They raise it to $60,000. Do another deal, pay it off. Renewable resource. We get to 5x or 10x our credit lines, guys. I want you to get this. The system is not bad. It's just that you're not playing the game. We want to get credit lines, and then every time we pay it off, we look so good to these guys, they keep raising our limits. And we get to use it, pay it off, use it, pay it off. That is a different version of leverage. That's a different version of the hypothecation of money. You have a $50,000 credit line, and you've done $500,000 worth of deals over a year or 2 or 3 months or whatever your pace is. Do you get this? It's not the system. The system is not bad. Thank the funding gods that the system is this way. They're hypothecating money. You also get to hypothecate money. You get to hypothecate money. So don't bewail your sorrows. Just get on the right side where you're turning a profit using the same $50,000, $100,000 credit line once, twice, 3 times, 4 times, 5 times, 6 times, and now you just hypothecated that financial instrument from $100,000 line to $1 million worth of deals. Feel me? Do you get this? This is what it's all about. So while I took you on a little, magical mystery tour of history of money, the point is don't hate the system. The system's only playing you because you don't know how to play. It's dunking on you because you don't know how to play this game. I'm saying, let's play this game well. Let's get our own instruments and let's hypothecate those as well. Let's use them a dozen times so that a $100,000 credit line, we'd take down $1.2 million worth of deals. That's 12 times your money. 12 times your money. This is Merrill Chandler. I love talking to you guys. This is my favorite thing. Thank you for joining me. Merrill Chandler, your host of the Get Fundable podcast. I will see you soon.
Thank you for listening to the Get Fundable podcast. Please leave comments because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you gotta tell your friends about this podcast because we want them to get fundable too.